Well, I will give you the short 1 minute or one sentence 1 sentence intro because I don't do that thing where they like read your whole bio. um and then we'll just get into questions. Um Nothing should be too surprising. Um Thanks for sending those sort of bullet point topics, but I think it'll be easy interview.
Yeah.
uh All right, wait. So look at my producer over here, Ryan. Okay, so I think we're ready to go.
And is this video or is this just audio?
Both. So we
Both.
have
Okay.
traditional podcast goes out on normal podcast platforms. Then we post interview the video to YouTube.
Okay.
I've always wanted to be a YouTube influencer, so that's my chance.
All right. I'm just slightly reframing my camera so it doesn't capture my unmade bed.
Great. Now I'd like to welcome to the show Alex Muresianu, federal analyst at the Tax Foundation here in Washington, D.C. Welcome to Free the Economy, Alex.
Thanks for having me, Richard.
Okay, so we want to talk about changes that we might see going forward to tax policy, especially at the federal level. So first, though, it might be useful to take a short look back at the last big changes we saw in Congress. So in 2017, Congress passed the TCJA, the Tax Cuts and Jobs Act. That was signed into law by President Trump. And that was one of the biggest, probably, tax reform packages we'd seen in a while, in many years at that time. So, Alex, what's the short version? What were the big changes we saw with the TCJA?
Yeah, so I guess breaking it down to sort of a couple segments. I think the biggest headline change, or I guess it makes sense to first, split tax policy into corporate and individual tax. Um, And so on the individual side, I think there are a couple of major changes. Number one, tax rates in each individual income tax, bracket, broadly reduced. Um, and then as far as uh, deductions go, the big changes were to expand the standard deduction while curbing major itemized deductions like the deduction for state and local taxes and the deduction for mortgage interest. Um, and so as a result, this substantially increased the share of taxpayers who filed their taxes with the standard deduction and reduced the number of taxpayers that filed with itemized deductions. It went from 70% standard deductions to standard deduction to around 90%, approximately off the top of my head. And then other notable change on the individual income tax side is a expansion of the child tax credit, doubling it from I believe 1,000 to 2,000. With the first sort of 400 of that increase being refundable, which means that you can claim it beyond just what you can reduce your tax liability by your total tax liability by to below zero. So that's the individual side. And then on the corporate side, you have a reduction in the corporate income tax rate from 35% to 21%. That is went from the U.S. statutory rate being very high for the OECD, near at the top, especially when factoring in states with their own corporate taxes, to around the middle. And then it also included some improvements for investment deductions for certain types of investments, allows companies to deduct closer to the full value of their investments, which they weren't able to and still largely aren't. We'll get into that a little bit more later. But for machinery and equipment investment. But there are also some unfortunate changes made there as well to try and balance out the budgetary costs, such as the amortization of research and development expenses. And so going, forward, there are a couple of issues. Is a lot of this law was temporary and scheduled to expire at some point in the 2020s, with the exception of the corporate rate cut, which is permanent, and a few other provisions. As well as the people also forget that it also included the repeal of the individual mandate, a topic that no one ever talks about anymore. I don't have a particular take to add either, but I just thought I would note that the TCJA did repeal the individual mandate of Obamacare. But you never hear people talking about that anymore. Or I guess technically it just reduced the penalty to 0. So, but
Well, that became a sort of hot topic when, for years, Republicans in Congress and then Republican, activists and advocacy groups didn't like Obamacare. They wanted to repeal it, or various parts of it. And the question of if you didn't get health care, then you had to pay a fee, or the question is whether it was a fee or a tax, and that sort of became a whole complicated legal issue.
yeah, I think that was one of the first politics stories I remember following like in depth as like a news consumer, not just like a thing that I was aware of happening. It was a thing that I paid attention to. It's kind of interesting how that has sort of become kind of moot, where that was getting rid of the penalty was like part of this bill or part of the TCJA, and now it's sort of left the political scene. I'm not a health policy person, but I guess this is more of a health policy question as far as what the effects of that have been. But I just thought it would be worth mentioning. It's the thing people don't really remember much about TCJA.
Yeah, absolutely. So you mentioned that big parts of that previous law from 2017 are going to be phased out, or are going to expire if they're not expanded. Do you have any sort of like political handicapping on how easy or difficult it will be to expand them? Presumably, since this is a Republican, led bill, Republicans will be in favor of extending most of the things that were only temporary to begin with. How do you think that fight's going to go down? What is it going to be? It's going to be easier to keep some of the stuff and jettison some others?
I think it really depends on the provision and the context. And I mean, I'm not like I don't know, some skilled Washington hand of the machinations of legislative politics. I'm mostly focused on the policy, but I think there's what I think we've seen before for a lot of these things, that there is like bipartisan interest in them. But as an example, for example, the child tax credit expansion, Democrats expanded even more in the American Rescue Plan, and that additional expansion expired, but child tax credit is still significantly bigger than it was before TCJA. And of course, TCJA was a partisan Republican bill, and the American Rescue Plan was a partisan Democrat bill. Both included expansions to the child tax credit. But and then with the R&D, so R&D amortization, I guess, to break that down a little bit, traditionally and in every other country in the world, companies deduct R&D expenses when they're incurred. So if you hire a handful of PhDs to do some experiments on some new I don't know, filament widget, then you deduct those costs when you incur them. But starting in the 2022 tax year, companies have to spread those deductions out over 5 years, or thanks to the half-year convention, which is kind of hard, but shorthand, spread these deductions over 5 years. And that means that, in real terms, you're deducting less because of the sort of opportunity cost of delaying the tax savings, as well as inflation means you're deducting less than the real cost. And so that's a tax penalty on R&D effectively. It doesn't make any sense. There was no real advocates for this policy. There's no one says no, this is the right way we should do R&D tax treatment.
Mm-hmm.
this was not like there was, as far as I know, there was no Democratic proposal to be like, no, we should like tax companies more by amortizing R&D expenses that I'm aware of. But I think there's a little bit of like and so it was like included a different, like there was a delay in the initiation of this policy, like in the Build Back Better package in 2021. And so I think both sides are kind of looking for horse trades, I think, as far as there's a lot of these provisions have like bipartisan interest, but in order to get like in order to get like one of them done, you need concessions or something to get it done on a bipartisan basis. I think my old boss Carl Smith had an article, I think, back in 2017 about basically sort of contrarianly like extolling the virtues of partisan tax reform, that like if you have like just one party not needing to make deals, you can like do a lot more ambitious things. I think more or less was his argument, and that you don't have to get bogged down as much horse trading as you might have to in a bipartisan context. But at the same time, I mean, at a first order level, you'd think that if there's bipartisan interest in fixing something, hopefully that would actually translate to something being done about it. Hopefully.
In an ideal world.
Yeah.
So that I think is an important thing to point out, which is why some people are, get confused about why is the tax code so complicated? Why is tax policy so complicated? Why do we have things that seem to even be working at cross purposes sometimes? And a lot of it has to do with like how the sausage gets made in the legislative process, where it's not an exercise in pure rational thinking. There's a lot of other interests involved and ideology involved. I remember, I forget who it was that when I was working at the Tax Foundation, one of my favorite quotes was from a sort of tax reformer said, I think at the very least, we should have a tax code that looks like it was written on purpose. Which I guess maybe isn't always the case. But when you talk about sort of like horse trading certain provisions, I think sometimes we use the phrase pay fors because there's a question about whether any change this is potentially true of any legislation, but especially when you're talking about taxes. If you cut taxes, for example, you would think, oh, well, there's less revenue coming in. So, well, if there's less revenue coming in at any given level of spending, there's going to be a bigger deficit. And so at least there's some idea that maybe we don't want an unstoppably large deficit every year forever. Although people aren't quite as strict about reining the deficit in as I might like. But in any particular bill, if there's a big bill, we're like, well, some things might cause revenue to go up and some things might cause revenue to go down. And so the, Congressional Budget Office comes out with a report and says, well, here's going to be the impact. And so if it looks like there won't be enough revenue coming in, then this happened even in the Affordable Care Act itself, where they sort of rejiggered things around and changed what you could deduct to get a good score, as they say. How big of a goal do you think that's going to be when we talk about these expiring tax provisions? Like, are we going to want a neutral score, something that doesn't make the deficit bigger, or do you think how much are they going to care about that?
I mean, I think part of that will depend on the politics of deficits, which have swung around pretty violently over the past 10-15 years. But I think the sort of core problem with a lot of the scoring with pay fors is that what you do if you're a politician, I suppose, is that you front load the fun stuff, the stuff that makes constituents happy, and the benefits, the outlays, or the revenue, or the tax cuts, you front load those. And then you have a bunch of tax increases or spending cuts, usually tax increases, that you schedule for like later in the budget window, that you might like ideally either plan on getting rid of, or just never actually end up going into law. So but that becomes a sort of separate issue from the specific bill at hand that will look, revenue neutral. I think going back to the Affordable Care Act, I think one of the big examples was the Cadillac tax, which always, confused me as a little kid. What does that have? What is a Cadillac? It's a car, right? Well, I didn't deal with health insurance as a younger person back then. So, but a Cadillac tax is a tax on, of course, high value insurance plans, and health insurance is excluded. Employer provided health insurance is excluded from the tax base, and this is a big problem, but also a very difficult, very unpopular issue, I think, to deal with or try and address because it's very baked in. And so the Cadillac tax was like a small step to taxing like certain high value employer provided health insurance as a part of a pay for the Affordable Care Act. And it never took effect. It was delayed and then just repealed. And so I think you can see a sort of similar but also different dynamic, especially with like the amortization of R&D expenses, where it was a policy that like no one thought was like a good idea, but it was just on paper, this will improve the score, and we'll get rid of it later. No one wants this. We'll figure it out later.
Mhm.
And they didn't, and now it's taken effect. So I think those are sort of two challenges, two similar and different examples of how that sort of process can play out.
Yeah, you can definitely imagine a 10-year plan where, you get ice cream for the first 5 years, but then for the next 5 years, you have to drink your bitter medicine. But
Yeah,
everyone's so excited about the ice cream in the first few years that they kind of forget about the other stuff down the road.
yeah, yeah. And that's part of also the dynamic with tax extenders, which a lot of them have actually, we've actually moved in a slightly better direction, where tax extenders are basically these policies that only last for like often like 1 or 2 years officially, and then they just keep being sort of renewed every year or two, and part of the argument there is that, on paper, extending it for 1 year, that's just $1 billion. So that's just $1 billion, fiscal ads, which you just keep like having to deal with the political process of renewing it every year, as opposed to, if you just made it permanent, well, on the 10-year score, that's $10 billion, $11 billion, or 15. That's a big number. So we can't do that. We just have to make it, renew every 1 or 2 years. In effect, this just creates a lot of like unnecessary uncertainty for like some unforeseen political situation where the extender doesn't get renewed, and a bunch of businesses are kind of left in the lurch, which is also what has happened with the R&D situation, where I think everybody a lot of, or at least a lot of people in politics and business world thought it was going to be fixed, and it wasn't, and so I think a lot of them have been kind of left in the lurch. So yeah, I think that's a particular downside of this kind of approach.
Yeah, and here's another angle I've been thinking about the sort of like the politics of taxes that is kind of interesting. So for some policy goals, like theoretically, Congress would have multiple ways of achieving it. So we could spend taxpayer money and buy something or give someone money. Or we could say, well, this is going to be a tax provision instead. And so we're going to give you a tax credit or tax, abatement of some kind to get it. And theoretically, it's six of one, half dozen of the other, right? Wouldn't necessarily make that much different fiscally. But so, instead of sort of handing money to someone for renewable energy or electric vehicles or something, it becomes a tax deduction. But then there's interesting situation where like we have now with Republicans in Congress. So a lot of Republicans in Congress have said specifically, among other policy priorities, that they want to like scale back renewable energy credits and policy in general. So if they want to like cut electric vehicle subsidies that are tax provisions, then they have to vote to eliminate a tax deduction, which scores as a tax increase, despite the fact that most Republicans on Congress have taken a pledge not to ever vote for a tax increase. So does that mean are Republicans who have like taken that sort of pledge like that checkmated and like painted into a corner because they can never vote for any program that's implemented through the tax code?
Well, I think you might have to ask the man behind the pledge himself to define exactly what is and is not a violation of it. But I think on a sort of purely on an economic level, I think it's worth, and I guess a legal level too, it's worth thinking about how credits and deductions are different. So, especially in the corporate tax, this makes a lot more sense on the corporate in the context of the corporate tax, where the corporate income tax is a tax on revenues minus costs. It's a tax on profits. And so a deduction means that you subtract your costs from your revenues to find your profit. So a deduction for something is just, that's a natural way of reflecting, what your profits are. And so if there's a deduction for an investment in, like, if you can deduct the cost of buying like I don't know, emission-free bus because you're transporting employees from a shuttle location, a shuttle location or something like that. It's like, well, sure, but there's also deduction for like a gas-powered bus or something that's like normal.
Right. Mm-hmm.
But credit like comes in sort of after these calculations are made and says, oh, you like deducted this cost. Well, guess what? You also get like a free, 70% of what that cost is and additional tax, tax relief or whatnot to further reduce your liability. And that becomes like very similar in practice to government spending. Because it's sort of a deviation from just this sort of basic like profits or revenues minus costs, and that corporate tax is a tax on profits. That's where you get into like a real issue there. And so it is and so like like repealing a credit does look like a tax increase, but economically it's a little bit more like a spending reduction. But I think people sort of conceptualize them differently in ways that I can understand. But I think tax credits are generally like spending. Tax deductions generally are not. But income tax is a little bit. Personal income tax is a little bit more dicey there. But yeah.
Right, because some of, like you said, the refundable credits, where some of them will only reduce the amount of taxes you have to pay to the government, but you don't get cash back on top of that. Right. So a refundable tax credit could say you don't pay any taxes and you get $500 back, but most tax credits aren't like that. They can just take you down to zero without the government having to pay you additional money on top of you not having a liability.
Right. But with the credits though, even if it's like non-refundable, it's still sort of like a deviation from normal sort of tax a tax system, where like there are, I guess, a couple of different philosophies for how to construct an income tax. There's like a consumption-based income tax, which the headline difference is that like a consumption-based income tax allows you to deduct savings. So basically all savings is either treated under like the Roth or the 401k format, where either you pay taxes on what you put in, but you don't pay taxes on the returns later, or you deduct what you put in, but do pay taxes on the returns later. But like but if there's like a credit for, I guess if we're thinking about a credit for an e-bike purchase or something, that would be like a deviation from like a normal income tax in either of these cases, because it's a subsidy, whether or not the credit is like fully refundable or not. I thought it would be like some sort of deviation.
All right. Now, when we look at, we mentioned some of the corporate tax code revisions, things like depreciation and research and development expenses, which are all just, common business expenses, of course. But I think when a lot of like normal Americans, not like people like you and me, normal people,
No, of course
when
not.
they kind of like tune out some of that news, I think, because they assume that only like rich guys and CEOs have any reason to care about that. But if we have better corporate tax policy, and we have a side conversation about what constitutes better, but what kind of kind of big picture impact would a normal American see from a really good corporate tax policy that they might actually care about?
Yeah, so the way that it's sort of an interesting the way I always compare this to which depending on which side you are, you get people get upset about this for different reasons. People get upset about this for different reasons. Sorry about that little notification noise. But that like pro long-term growth policy has like very similar um like like pro and con or like political challenges to climate policy to me, where the political case for, say, climate, more aggressive climate policies is, at least for the activists, the world's going to blow up in 10 years if we don't do this now. Whereas like really the costs of climate change are like spread out, like increased tail risk and like or tail risk plus like generally like slightly elevated levels of like natural disaster and higher temperatures leading to reduced agricultural yields and stuff like that. There's just very like granular stuff that like adds up to something significant, but like it's not like an immediate term. Like if we do this, like they're going to be like your house is going to get like wiped away in a flood next year, but if we do this it won't. Like that's not really what like climate policy is about. And it's sort of a similar concept with like thinking about like the corporate tax code and pro growth tax policy broadly, is that like the making sure the tax code doesn't penalize investment is about making sure we get more investment, which translates to productivity growth, which translates to wage growth. But like that causal chain takes some time. Like you've got to like deploy you've got to make the plan, you got to make investment plans, you got to deploy the capital, it's got to be put into action. And that sort of gradually takes place over years. And so this was like a kind of a difficulty, like especially early on with the TCJA, where like there was like the economy was like very strong in 2018, so there was like an urge to say like, see, like Tax Cuts and Jobs Act is like totally vindicated because of this. Because like, but I think a lot of that was a more short-term like labor market impact, where you had like it was a big tax cut, so there was a lot of like aggregate demand increasing, and so people were hiring, and there was like fiscal space that we weren't using, that we could use thanks to that we were using thanks to the tax cuts. And so it wasn't the same like investment growth story. It was just sort of the initial thing was mostly, I think, a short-term response, but that the long-term response is like hard to isolate, but it's like well supported, and like literature about taxes on investment are quite distortionary. But like isolating that impact, just sort of looking at like a time series graph of like wages is kind of difficult. I mean, whenever someone does like a bad, like Paul Krugman will sometimes do like a bad, like, see, taxes got cut here, and then like things like didn't grow for these years afterwards. And so you can very easily put together like a very similar graph that says, oh, look, taxes were cut here, and then like wages blew up. But that also is not like quite how the causal chains like would make sense.
Yeah, so maybe the best thing that can come out of tax reform is just a slight increase in steady economic growth, but that is both doesn't show up dramatically on a chart, and it's also not the hot sexy thing, right? It's not putting out a fire or stopping a disaster. It's just slightly elevated standard of livings over time, so it doesn't get as the headlines as much, I guess.
Yeah, it's I'm a big fan of Red Letter Media. Are you familiar with them? Oh, they're just like they're like a movie criticism or YouTube channel, but they have like this quote about like they're famous for a review of the Star Wars prequels, delivered by a particular character of theirs, and he has this sort of phrase where he says, you didn't notice it, but your brain did. About like a certain type of, and so I feel like it's a similar idea where over time you might see a 5% increase or something in wage rate, over time. But it's not like, oh, the tax cut here and then boom, that's like right away that happens. It takes time to take effect, and maybe by then you're not like, oh, that was because of the tax cut that was passed 5 years ago. But it deploys over time, and that's about like improved productivity. That's not just mechanically being like, we have reduced your taxes like on paper by $5,000. It's because like you're making more money because like investment and productivity growth have taken place. And that's like the hard, that's what policymakers are bad at. They're very good about just handing out money to hand out money. It's a much more, I would say, noble, but also more challenging task to actually like increase like productivity as a way to raise wages.
Well, yeah. So this, I mean, comes to what I was going to end with here, which we've already sort of gotten into, which is, so when it comes to the politics of taxation, the stereotype is the Republicans always want to cut taxes, and then Democrats always want to raise taxes to fund new government programs. But not only is that not always true, but like at the Tax Foundation, they like to talk about the principles of sound tax policy, right? So I think it's some people in partisan politics that has not occurred to them that there is such thing as as how to conduct a good, smart, like non-stupid tax policy that is not just about always cutting or always raising or always cutting certain people's taxes and always raising other people's taxes. Can you just talk real quick about what it even means to have principles of sound tax policy?
Yeah, so I guess the way that I think about it is like, government exists, you're going to need money to fund what it is you think government should do. What's the easiest way to get there without creating while creating the least amount of harm from the revenue collection you're pursuing? What's the least harmful way to get to this number, which is the amount of revenue you need? There's the French finance minister from the 17th century, Jean-Baptiste Colbert. It says taxation is the art of plucking the maximum amount of feathers from the goose with the minimal amount of hissing. Is like a sort of famous, I think I'm slightly mangling it, but it's like a famous quote. So and so I think like with a lot of people talk about like European countries who have like a very high or have a higher like taxes as a share of GDP ratio than the United States. But I mean they're not like necessarily. I mean some I don't want to speak generally they're have grown like slower than the United States, but like some of them have roughly kept pace. But the reason why they're able to like maintain this like much higher level of taxes to GDP is that they often like tax better, but the rates are higher, so that sort of offsets it, but it lets them still continue to grow a little bit. And the big factor here is that they have a value added tax, which is as do like basically every I think every European country does. And basically a value added tax, it's a tax of the value added at every stage of the production process. Think of like a wooden toy. I don't know, you have like a forestry company that sells the tree to a factory that sells the toy to your local toy store, something like that. Or Amazon, more realistically, or Etsy. And so, basically what it comes out to is a consumption tax. And this is like a pretty non-distortionary way to fund government. It doesn't negatively impact investment. It doesn't punish saving, because it only taxes income once, because it's either you either consume income now or later. And when taxes on income include capital gains, it taxes income both like when you earn it and when you consume it, or when you take something out. And so that's some of how like European countries are able to like fund their more expansive welfare states. And the US meanwhile has like a quite progressive income tax system, but the rates aren't particularly high relative to Europe. At least thinking about the individual side, the corporate rate is around the middle. But so that's like one example of where sort of generally like sound tax policy is sort of broad, like a broad flat consumption tax is like a very efficient way to raise revenue. No matter if you want like a small state or a medium large state. There's a joke in DC, which I'm sure you've heard before. I think it was a favorite of an old, probably shared boss of ours at some point about the value added tax. There's a old Washington joke that the thing is the thing about the VAT is that Democrats think it's a tax on the poor, and Republicans think it's a money machine for big government. And if only we could convince the Democrats that it's a money machine for big government, and the Republicans that it's a tax on the poor,
then everyone would love it.
yeah. But and so I think that sort of neatly explains the political challenges of doing that. But I think the other angle, as far as the changes in how policymakers are going to be thinking about tax going forward, is related to like the politics of deficits. Are we in a 2010 to 2016 like Republican, which I think generally, at least for the next year and a half, we're definitely going to be in the Democratic presidency, Republican House, like a lot more for restraining government spending? Or are we in the like 2017 to 2022 framework of policymaking, which was more or less we actually don't care about deficits at all framework? I think that significantly changes the dynamics around all kind of things. I think in some ways, I think the Inflation Reduction Act was, I think, like a final expression of that, although on paper originally it was close to revenue neutral, but I think now with better estimates of these green credits is definitely not revenue neutral. That was the last vestige of the like Green New Deal MMT adjacent, not to say that
big spender.
Yeah, not to say that like the IRA is like a full MMT proposal, but that like there's general philosophy that like we're not constrained by tax revenue. We can keep spending money because we've had low inflation. We had low inflation in the 2010s, and so people were realizing when we did a big tax cut, inflation didn't increase. Well, we got a lot of fiscal space. Why don't we just go all out, in this Green New Deal proposal? It's fine. See, we increased the deficit, but inflation didn't go up, and we haven't encountered any problems from that. But then we sort of did a whole lot of spending in response to COVID, and then we said, well, there is a limit here. So I think the like subsidy approach to like climate policy was, very popular in response to that sort of realization in the late 2010s, and the IRA was sort of a last gasp / actually implemented version of it. But we'll see if that sort of changes going forward, given that the politics of deficits and the realities of deficits are different.
Well, yeah, it seems like, especially within environmental and climate issues, that there was a mix of carrots and sticks at one point, having like the EPA trying to like force utilities to emit less, and then that didn't work out. So we're all carrots from now on, all subsidies. But in terms of like the big sort of overall politics of it, I think conservatives can count on the Republicans to be to cut taxes or hold the line on taxes because they want lower taxes. But I think even people who aren't particularly conservative feel like, well, at least if things get really out of control, the people on the Republican side will slow it down a little bit. Even if people who don't want like tax cuts nonstop all the time, they sort of depend on the Republicans to just sort of kind of balance things out at least. And I think there's a lot of like political science literature that kind of points to that. But when it comes to both sides of it, right, we've got we've got the spending side and the tax side. Republicans have been really good at voting against tax increases in general over the years. They have not been really good at not voting for big spending bills. So it's one obviously for obvious public choice reasons. One's easier to do than others. But it'll be interesting to see whether there's more kind of anti-deficit discipline. And though, as you said, that will probably depend a lot on the political environment, who's in the White House, how much they can get done otherwise.
And I think the economic environment generally also, especially with inflation is, steadily coming down. I think the when inflation is, hopefully back to normal in, a year or two time, I think we'll see how dramatically things shift back to a pre-COVID status quo, where people were not talking about inflation as a going concern, or as a major concern. And so I think waiting for events, I suppose, is the long and short of it.
Yeah, I think now that we're past this debt limit deal, we'll be looking at bigger budget deficit, and then tax bills coming forward. All right, Alex, thank you so much for being with us. This has been a fantastic conversation. And tell people where can they find your fabulous work online.
Thank you, Richard. You can find my work on the Tax Foundation website. On the if you're looking for my work specifically, you can find me on the staff page, or just go to the Tax Foundation blog, where you can find all our work at Tax Foundation. And you can also find me on Twitter at @ahardtospell.
So don't try and spell his last name. Just A hard to spell.
Just hard to spell, yeah.
All right. Thanks again, Alex. And we'll check back in with you hopefully if we have a new major tax bill.
Yeah, sure. I'd love to.
All right.
Fun to be here.